One of the hardest decisions to make in retirement is where to pull your money from. This could either save you a lot of dough or it could cost you a lot. Uncle Sam loves it when you do it the wrong way because you know what? You're going to pay them a lot more in taxes. So instead of just trying to guess on this, I built out this nest egg in our financial planning software that we use here for clients at Jazz Wealth to really model this out to show you some examples. And so if we haven't met, I'm Eric with Jazz Wealth Managers, where we don't just invest your dough. We like to educate you on your dough. All right, so let's go ahead and show you this right here. So we've got Louis and Lucille Armstrong. They're both 61 years old. Now, Louis is still working. He's going to retire at 62. They're going to have $1,700 in Social Security coming in for him, $1,500 for her. He's making $140,000 a year. There we go, that word. So he's retiring at 62. Lucille is already retired, and they want to live on $5,500 a month. Now, you first got to start and say, okay, well, what type of accounts do they have? And so they've done very well for themselves saving. They've got $823,000 as a net worth. In their taxable accounts, they have $123,000. Now, they do have a cost basis here of $75,000. So that means, that's what they paid for this stock. That's how much that they actually have in the stock that they paid for. It's grown from there. So the 123 minus 75 is going to give you what your profits are. For the 401k, Louis got a 401k, all pre-tax money. He has $380,000, and Lucille, she liked the Roth. And so she wanted to do the after-tax and growing tax-free money here, $320,000. So that's the breakdown. They've got a good range of types of accounts to work with. Now, first, we're going to go ahead and just take a look at the general idea here. And so if we're looking at the current plan as our general idea, I went ahead and worked on the proposed as well, and I'm going to go into that and show you the differences here in a second. But this is your current plan, 84% probability of success. And how this is going to work is if we say, okay, well, what does that mean, 84% probability of success? If you've watched any of our videos before, we're happy with that number in general, but can we make it a little better? And as you can see, I'd already kind of done some planning ahead. And so with the proposed plan or the current plan, what we're looking at is them taking their money out in a pro rata approach. And so there's, basically there's no more dollars that they're going to make or have at the end of the plan by doing this. But to give you an idea of what a pro rata approach means, let me show you. So it's basically breaking it down so you're going to take equal proportions of the account out from each account during retirement. So, let's just say you're going to take 100% out. You've got 33% out of one account, 33 out of another, and 34 out of the final account to give you this breakdown. So in a sense, that's what we're looking at right here. As you can see, you're going to do equal distributions from each account on a percentage basis. But what if we say, well, let's look at some different approaches? So I've got these built in here to take a look and show you. So one of them is your taxable and then tax deferred, and then finally the Roth account, that tax-free account. If we look here, you would have $75,000 more at the end of the plan just by doing that strategy instead of trying to take it all at once out of different accounts. Now, what about if we did a taxable, tax-free, then tax deferred? Doing that approach, you're spending down the Roth, you're going to have $61,000 more. So you're still going to have more, leaving the tax deferred money, which is all of that RMD money for the final process of things. But as you can see on this chart here, it's actually showing you that, a lot of their income is going to be in the later years because they're right here in this little window, they're spending all of the Roth down. Now, what if we say we do the tax deferred first, then the taxable account, and then the tax free? Doing that one gives you $85,808 more at the end of the plan. Based on this scenario, that's the best. But what I really want to show you on all of this and how it's going to affect the plan, what I want to explain with this scenario is that for every single scenario that I'm actually running through here, the tax-free amount, that Roth account, seems to always be best used last. That's because it's going to allow you to truly grow this tax-free. And, long term, you're going to have this nice nest egg that you can pull from at the end of the plan. You don't have to worry about RMDs. From an estate planning strategy as well, it's nice because you can pass that down to the kids without them having taxes. And so looking there, you've got these different approaches. So for this scenario, this is the best. It's interesting because I oftentimes see it a little different than this. But this just goes to show you that every single person and plan is a bit different. But with this approach right here, this distribution proposal is what I set in. It gives them an 86% probability of success. And so if you're right on the fence and maybe you feel like, hey, you know what, things are going to be tight in retirement, this could give you that little bit of a slight bump, just enough to increase to make sure that you are comfortable in retirement. So it's one that you really want to pay attention to. If you haven't, you can check with us here at Jazz Wealth Managers by going to jazzwealth.com, and we'd be happy to help you. Thanks for watching. If you want to watch more FinTips videos, click here. Be sure to like and subscribe also.